Today, we will talk about what income tax payable means in financial accounting. Income tax payable is a liability that an organization expects to pay in income taxes within 12 months. It is reported in the current liabilities section of a company's balance sheet and is determined in accordance with generally accepted accounting principles and tax rates in the jurisdictions where the organization is subject to tax. For example, United States taxpayers are subject to federal, state, and local tax laws, as well as the tax laws of any other countries where they operate and realize income. The amount of taxes owed under applicable tax laws for most events reported in the financial statements for a year are included in the amount reported as income tax payable on an organization's balance sheet. Income tax payable is shown as a current liability to the extent of the amount that will be resolved, i.e., paid, within 12 months. Tax liabilities that have accrued in a year, but whose payment is due in a later year, are shown on a balance sheet as deferred income tax liabilities. Differences in reporting for the two systems, particularly with respect to the timing of tax liabilities, are reflected on an organization's financial statements. Balance sheets report the actual amount of taxes owed to the IRS, categorized either as current tax liabilities, i.e., income tax payable, or deferred income tax liabilities, which are non-current, longer-term liabilities. However, income tax expense is reported on an organization's income statements, and is usually determined by applying the current corporate tax rate to the amount designated as profit before income taxes. Taxes due in future years are listed as deferred income tax liabilities. If the corporation also owes state, local and foreign income taxes, its balance sheet will reflect those liabilities as well. Income tax payable is a financial accounting term for the current liability reported on an organization's balance sheet. It indicates the taxes that the organization expects to pay within 12 months. The rules determining these amounts and their purposes differ. The amount of taxes to be paid to the IRS is determined by the tax laws applicable to a taxpayer's income, and these actual tax liabilities are determined annually. Here are 5 key takeaways. 1. The rules for determining the amount of taxes owed government tax authorities for a year and the financial accounting rules for reporting taxes on financial statements differ. 2. For U.S. companies, the taxes reflected on financial statements include federal, state and local taxes as well as taxes imposed by other jurisdictions where the companies operate and realize income. 3. Income tax payable is the financial accounting term for a current tax liability reported on a company's balance sheet. 4. The balance sheet amount for income tax payable equals the amount of taxes due to be paid to government tax agencies within 12 months. 5. Income taxes to be paid in a future year are reported on the balance sheet as deferred income tax liabilities. Hope this would help. Thanks for watching.